Okay, let's unpack this. We're diving into a sector that's, well, it's really surprised many by sparkling so brightly, even while some other big parts of the economy have looked a little, muted.
Hmm.
We are talking about the Indian jewelry sector.
That's right. And we've pulled together information from transcripts of several interesting sources, YouTube discussions. Each one gives us slightly different angles on this market, the companies in it, and what's really making it tick.
And our mission for this deep dive, well, it's to cut through the noise and really understand why this sector is seeing such standout growth. We want to get a handle on the key organized players, compare them based only on the data and insights we found in these sources.
Right, only the sources.
Identify the opportunities and the potential risks, and ultimately figure out what's most important for you to know about this whole space.
And here's the thing that jumps out right away, this sort of surprising core of the story from these sources.
Yeah.
At a time when major sectors like, say, banking, FMCG, consumer durables, they're showing relatively poor growth numbers, right? Struggling with weaker consumer demand overall.
Mm-hmm.
The Indian jewelry sector is seeing really significant growth. I mean, the sources note that even companies performing, let's say, less strongly within the space, even they have recently reported growth rates north of 25%.
Wow, 25% even for the weaker ones.
Yeah.
That really is counterintuitive, isn't it?
Yep.
Especially against the broader economic backdrop.
It is. You'd think luxury spending would be the first thing to slow down.
Exactly. But this sector's booming. So what did our sources point to as the fundamental reasons behind this?
Okay, well, the first thing that really stands out is just the sheer size and the potential of the Indian jewelry market itself.
How big are we talking?
Currently, it's estimated around, say, $80 to $85 billion. But the projections shared, citing reports like one by Crystal, they suggest it could see dramatic growth, like potentially nearly tripling. Yeah, to maybe $145 billion by FY28.
$145 billion by 2028. That's immense. It's described in the sources as a very large industry, maybe even rivaling sectors like cement or steel or infrastructure in the country.
Absolutely. And when you look at why it's growing so fast right now, especially, counter to those other sectors, the sources really highlight what one of them calls the India One factor.
India One. Okay, what does that mean exactly?
It's a term used to describe basically the top 10% of the Indian population. The key insight here is that the organized jewelry sector, it primarily caters to this wealthy demographic. And their disposable income has grown, well, exponentially in recent years.
So for this group, jewelry isn't really seen as like a discretionary purchase, something that gets cut when things feel a bit tight economically.
Precisely. For them, it often falls more into a luxury category or even, a traditional, almost non-discretionary spend. Their spending power just isn't significantly affected by the general GDP growth rate or the slowdowns impacting the wider population.
So that rapid increase in wealth right at the top, that's a major driver mentioned for this recent strong performance.
Yeah, specifically for the recent performance, that's highlighted as a key reason.
Okay. So the concentration of wealth is powering a lot of this current boom. But India's connection with gold, that goes much deeper than just recent income growth, doesn't it?
Oh, absolutely. It's fundamental to the culture. India has this centuries-old love affair with gold.
Right.
It's not just an investment. It's deeply embedded in traditions, essential for weddings, major festivals like Diwali, other ceremonies. Mm-hmm. It serves as this powerful symbol of wealth, status, tradition, and it's often passed down through generations.
And you can see the scale of that cultural connection in the numbers, right?
Yes.
India is the second largest gold jewelry market globally.
Yeah.
Was it 562 tons consumed just last year?
Exactly. 562 tons in 2023 alone. So you've got this short-term boost from the India One factor kind of layering on top of this incredibly strong long-term cultural demand.
That makes a lot of sense. It provides a really robust foundation for the sector, doesn't it?
Right.
It's not just about economic cycles. It's woven right into the fabric of society.
Mm-hmm.
So beyond the India One spending power and that deep cultural significance, what other factors, what other tailwinds are the sources pointing to that suggest this growth could continue?
Well, several significant trends were highlighted. First off, just the sheer scale of the wedding market. That's a constant driver.
Right.
India sees around, 1 crore weddings every year?
1 crore? That's 10 million weddings.
Yeah, and estimates of spending go up to 4 lakh crore rupees. So the wedding season is consistently a major catalyst for jewelry purchases.
That's a massive recurring demand base right there.
Yeah.
Okay, what's the next big one?
Perhaps the most impactful long-term trend discussed is the significant shift happening from the unorganized jewelry market towards the organized players.
Ah, the shift to organize. How dramatic is that shift, according to the sources?
The numbers shared are quite telling, actually. The organized market only held about, say, 10-15% share back in 2001.
All right.
By 2022, that had grown significantly to maybe 33-38%, and the projections suggest it could reach 42-47% by FY26.
Wow.
And potentially hit around 50% by FY28. So yeah, the organized sector is rapidly grabbing market share from those smaller, unorganized jewelers.
Okay, but why are consumers moving towards the organized players? What's driving that change?
There are several key reasons mentioned. Trust and quality assurance are huge.
Right.
Organized retailers offer BIS Hallmark certified gold. That provides much needed transparency in quality and pricing. It builds confidence, especially for consumers who might have been wary about authenticity or pricing games in the past.
So knowing you're actually getting what you pay for, that's critical.
Absolutely. And brand reputation matters too. Established brands are just seen as more reliable. Plus, they often provide better resale or exchange value on your old gold.
That makes sense.
And then there's the whole customer experience thing. Organized players invest in that. They offer a wider range of modern designs, nice, well-designed showrooms, loyalty programs. It just makes the whole buying process more appealing.
And I imagine the marketing plays a big role too. All those ads and celebrity endorsements.
Yes, definitely. Heavy advertising, celebrity tie-ups that create strong brand recognition and, pulls customers into their stores.
Has government policy played any part in helping this shift along?
A very significant one, actually, the implementation of GST that basically wiped out the price advantage that unorganized players used to have, from underreporting sales through gotcha bills or informal receipts.
Right, it leveled the playing field on price.
Exactly. And then you have requirements for hallmarking, PAN numbers for larger transactions that further formalizes the whole sector. The government's stated goal, according to the sources, is really to bring more of this industry into the organized, regulated fold.
So regulation, maybe counterintuitively, is actually acting as a tailwind for the organized players by forcing more transparency.
Precisely. It creates a more standardized, accountable environment, which naturally benefits the larger compliant businesses.
Okay, so we've got the cultural demand, the India One factor pushing recent growth, the massive wedding market, and this huge shift to organized retail helped along by regulation and brand appeal. What else? Are younger buyers getting into the market too?
Yes, that's another interesting point raised. Younger generations, particularly those maybe aged 20, 35, often called Gen Z in this context, they are increasingly interested in buying jewelry. Now, their preferences might lean more towards modern, maybe lightweight daily wear designs rather than just the heavy traditional wedding sets.
Sure.
But their entry into the market expands the overall demand pool beyond just the most traditional buyers. It opens up a whole new segment for growth.
And the organized retailers are jumping on it.
Yeah. They're responding by aggressively expanding their physical presence, opening stores rapidly across the country, including, importantly, in Tier 2 and Tier 3 cities to capture this growing demand wherever it is.
We also heard a quick mention earlier about gold prices and import duties influencing things.
Correct. Gold prices themselves, they've been volatile but generally trending up, gave significant returns last year apparently, and then there was that government decision to cut the gold import duty from around 15% down to about 6% last year.
Right.
Now, initially, this lowered domestic gold prices, which, gave consumer demand a bit of a boost temporarily.
Aided for consumers.
Yes, but, and this is an important operational insight we need to dig into later, it also created significant inventory valuation challenges for companies holding large stocks of gold bought at the previous higher prices.
Ah, okay. So while the big picture tailwinds are strong, the cultural base, India One, weddings, the organized shift, younger buyers, expansion, there are also these external factors like price swings and policy changes that can create real operational headaches.
Exactly.
So who are these organized players driving all this change, as mentioned in the sources?
Okay, the sources discuss several key listed companies. In the B2C space, the retailers with the showrooms you actually see, the main ones highlighted are Titan, Kalyan Jewelers, Senko Gold, PN Gadgil, and Tengamale Jewelers.
Right. Were there also B2B players mentioned? Companies supplying the retailers.
Yes, companies like Sky Gold and RBZ Jeweler were noted as operating primarily in that B2B segment, supplying maybe other manufacturers or smaller boutique retailers.
But wasn't there one company with a slightly different or unique business model?
Goldium. Yes, Goldium was mentioned as having a unique profile. They're primarily involved in manufacturing lab-grown diamonds, mostly for the B2B export market, supplying large global jewelry chains, apparently mainly in the USA.
Interesting.
And they're also reportedly testing a B2C retail approach themselves.
Got it. And among those main B2C players, Titan is often called the sector king, isn't it?
Yeah. Absolutely. Titan is widely acknowledged as the dominant player. They really pioneered organized jewelry retail in India, starting from their watch business, right? And they leveraged that massive trust associated with the Tata Group name. They definitely hold a significant leadership position.
Okay, so we know who the main players are, the big market drivers.
Yeah.
Let's get into the weeds a bit now. The sources provided some comparative numbers. How do these players actually stack up when you look at the data? This is where it gets really interesting.
Indeed it does. Let's look at some key metrics provided, particularly I think it was the Sahil Budhvia source, which offered a pretty detailed comparison.
Okay, first off, let's talk scale. Just how big are these companies relative to each other?
Right, well, by market cap and just physical footprint, Titan is really in a league of its own. We're talking a market cap around 3 lakh crore.
Wow.
And over 1,000 stores across its various jewelry brands like Tanishq. Kalyan Jewelers is the next largest. Market cap around 80,000 crore and over 300 stores, including some overseas ones.
Okay, so Titan and Kalyan are the giants. What about the rest of the B2C players mentioned?
P.N. Gadgil and Senco Gold. They're much smaller by comparison. Market caps both around, say, 9.4, 9.5 thousand crore. P.N. Gadgil has around 48 stores, mostly concentrated in Maharashtra and Goa. Senco has a larger store count, about 166 strong in eastern India.
And Tongamail.
Smaller still. Around 5.5 thousand crore market cap, about 60 stores, mainly down in Tamil Nadu.
So yeah, there's a huge gap between the top two and the rest, just purely in terms of scale. What about growth if we look at trailing 12-month or TTM numbers?
Okay, the growth picture is quite varied. Looking at TTM revenue growth, Kalyan showed strong performance, up 33%, and P.N. Gadgil was even higher at 38%.
38% revenue growth, nice.
Yeah. Titan and Senco grew revenues solidly too, 17% and 23% respectively, similar to Tongamail's 23%. Now, Sky Gold, that B2B player, they showed truly extraordinary TTM revenue growth at 84%.
Whoa, 84% revenue growth is massive. But like you said earlier, profit growth is where the rubber really meets the road. How did their TTM profits look?
This is where we see some really notable differences. P.N. Gadgil showed outstanding TTM profit growth at 179%.
179%.
Yep. Senco saw decent growth, 28%. Kalyan also grew by 21%. But interestingly, Titan's net profit actually declined by 2% TTM.
Declined, even with revenue growth.
Yeah. And Tongamail and RBZ also saw profit declines, Medic at 15% and Enik at 4% respectively. Sky Gold, though, mirrored its revenue growth with extraordinary profit growth at 162%.
Okay, so P.N. Gadgil and Sky Gold really jumped out with their TTM profit growth figures. Why did Titan's profit decline then, even with rising revenue?
That links back directly to those inventory challenges we mentioned earlier, the ones caused by the import duty cut and the subsequent fall in gold prices. We'll get into the specifics of that quarterly impact in a moment.
Gotcha. Okay. Let's move on to profitability and efficiency. Operating profit margin, that's always a crucial metric in retail, isn't it?
Absolutely. And Titan has a clear advantage here. They show significantly higher operating margins, typically around 9-10%. Compare that to Kalyan at around 6%, P.N. Gadgil around 4%, Senco at 8%, and Tongamail also around 4%.
So why is Titan's margin so much higher than most of the others? Is there a specific reason mentioned?
Yes, the sources highlight a key reason. It's Titan's method of financing its inventory. They predominantly lease their gold.
Leases.
Yeah, which has a cost equivalent to only about 2-3% of the gold's value, apparently. Other players often need to borrow money to purchase their gold inventory, right? And that incurs interest costs typically ranging from maybe 8-10%.
Ah.
So that significantly lower inventory financing cost gives Titan a substantial structural advantage in its operating margins.
That's a critical insight. Wow. That difference in how they get their core asset, it translates directly to better margins. What about return ratios like ROE and ROC? How efficiently are they using their capital?
Right. Return on equity and return on capital employed. Titan demonstrates extraordinary return ratios here too. Around 32.9% for ROE, 22.7% for ROC.
Very strong.
But PN Gadgil also shows fantastic ratios, very competitive with Titan, actually, 32.4% ROE and a really high 30.8% ROE. Other companies have good, but generally lower ratios, like Kalyan around 15% ROE, Senco around 16% ROE.
So both Titan and PN Gadgil look notably efficient at generating returns on the capital invested in their business based on those numbers.
Yeah.
How quickly are they selling their inventory? Inventory days should tell us that.
Right. Inventory days measure how long, on average, a company holds on to its stock before selling it. Lower is generally better. PN Gadgil at 62 days and Sky Gold at 59 days have significantly lower inventory days compared to Titan at 176 days or Senco, which is way up at 200 days.
Wow, big difference. So PN Gadgil and Sky Gold are turning their inventory over much, much faster.
Seems like it. Faster inventory churn generally means your capital isn't tied up for as long.
And asset turnover. How much bang are they getting for their asset buck?
Asset turnover looks at how much sales revenue a company generates for every rupee of assets it owns. Again, PN Gadgil at 4.81x and Sky Gold at 4.17x have very high asset turnover ratios.
Very high.
Compared to Titan at 1.74x or Kalyan at 1.58x. This means, based on these numbers, PN Gadgil and Sky Gold are generating significantly more sales output from their asset base.
Okay, so pulling that together, while Titan absolutely dominates in scale and has that crucial margin advantage from leasing gold, PN Gadgil and Sky Gold appear remarkably efficient in terms of how quickly they move inventory and how much sales they squeeze out of their assets based on these TTM figures.
That's what the numbers suggest.
Finally, just quickly looking at balance sheet strengths, what about debt to equity? How leveraged are they?
Among the listed B2C players where this was reported, PN Gadgil stands out again with the lowest ratio at 0.16. That suggests a much less leveraged balance sheet.
Very low.
Yeah. Titan is significantly higher, around 2.22. Kalyan's at 1.04 and Senco at 1.31. Sky Gold was around 1.35.
Okay, those numbers give us a really useful quantitative picture. But the business model nuances, the strategies, they're also key, aren't they? What else did the sources highlight about how these companies actually operate and strategize?
Right, beyond the pure numbers. An important factor mentioned is the studded ratio.
Studded ratio, that's the percentage of sales from jewelry with stones, like diamonds.
Exactly, and that generally carries higher margins than plain gold jewelry.
So a higher studded ratio usually means better profitability potential, right?
Generally, yes. And Kalyan is noted as having the highest studded ratio among these players at 30%. That helps them compete on profitability, even with lower overall operating margins than Titan.
Makes sense. Titan's studded ratio was mentioned around 23%.
Yeah, around 23%. Senco is lower, about 10%, and PN Gadgil around 7.5%. Although the sources do mention that PN Gadgil's studded ratio is apparently increasing.
Interesting. So Kalyan's really pushing those higher margin items. What about how they're expanding their store networks? Are they all just building their own stores?
Not entirely. Kalyan, for example, has expanded rapidly partly by using a franchise-owned, franchise-operated model, FOFO, for about 40% of its stores.
FOFO. Okay. How's that different?
It's different from the traditional company-owned, company-operated, or Coca-Co model. The EFO-era approach requires less capital investment from the company itself.
The franchisee puts up the capital.
Right, which allows for quicker expansion. And Senco and PN Gadgil are also reportedly using the FOFO model as part of their strategies to expand their footprint, including plans to move beyond their traditional home regions.
That seems like a pretty smart way to scale faster without putting too much strain on the company's own balance sheet. Are there other schemes or strategies that help manage operations, particularly around inventory?
Yes, gold exchange plans were mentioned as being significant.
Where customers trade in old gold for new.
Exactly. And this is really beneficial for the retailers because it reduces their need to import new gold, saves on import duties, acquisition costs.
Right.
Titan apparently gets around 35% of its inventory through these exchanges, Senco about 38%, and PN Gadgil is actively focusing on this too, already sourcing about 28% of its inventory this way.
So these exchange schemes are pretty important for reducing reliance on fresh imports and helping manage inventory costs. Speaking of inventory and import duties, let's circle back to how that import duty cut we mentioned earlier actually impacted the company's recent quarterly results, as detailed by the sources. That seemed like a real test.
It really was. Okay, so when the import duty was cut, it led to that rapid fall in domestic gold prices. Companies holding significant inventory bought at higher prices. They faced potential losses on the value of that stock.
Makes sense.
This is where hedging became crucial. Like financial protection companies used to guard against unexpected price movements.
Right.
Now, Titan's net profit saw a temporary dip in Q2 because of this. But the sources note they had effective hedging strategies in place which helped them recover those inventory valuation losses by Q3. So their Q3 net profit ended up being relatively flat year on year despite sales growth.
Okay, so they managed it eventually. And how did Senko fare during that same period?
Senko's experience was quite different, according to the sources. Their Q2 profit actually increased year on year, which was attributed to aggressive hedging at the time.
Okay, sounds good.
But the sources highlight that this hedging strategy seemed to backfire badly in Q3. It led to a substantial drop in their net profit and a reported loss of around 90 crore rupees in that quarter.
Ouch. 90 crore loss.
Yeah, even though their sales were still growing. So it really shows the double-edged sword of hedging, right? It can work, or it can really hurt if the market moves against your position.
Definitely a risk. What about Kalyan during this volatile period?
Kalyan's Q2 results showed relatively flat net profit, but their Q3 profit actually increased year on year despite all the gold price volatility.
So they navigated it better than Senko, it seems.
Operationally, yes. One source specifically commented that Kalyan's stock price dropped during this period, which was quite notable. It seemed to be more related to its very high valuation at the time.
Ah, the valuation.
Yeah, a PE ratio reportedly reaching 128 according to one source, rather than actual poor operational performance related to the gold price swings. Though other factors like, unconfirmed news might have played a role in the stock movement too.
Okay, so that whole import duty situation gave us a very clear look at how crucial operational factors like inventory management and hedging are, and how they played out very differently for these companies.
Yeah.
Let's maybe spotlight a couple of these players based on what the sources emphasized. First, PN Gadgil. What makes this relatively smaller company seem interesting based on the analysis?
Right, PN Gadgil. They have a very, very long history, over 150 years apparently, but they're a more recent stock market listing. They have this very strong regional presence, primarily dominating the market in Maharashtra and Goa. And as we saw in the numbers, they demonstrated really strong TTM growth in both revenue and profit. And importantly, they seem to navigate that challenging Q2 period without the profit declines seen by some of the others.
And they seem to be actively adopting best practices from the bigger players.
Yes, exactly. The sources note that PN Gadgil is actively implementing strategies that have worked well for the larger players. They're significantly increasing their use of gold leasing to lower inventory costs, reportedly reaching 42% of inventory in Q3.
Closing that gap with Titan.
Exactly. They're using the FO model for planned expansion outside their core region. And they're growing their gold exchange plan contribution already up to 28%. Plus, they also provided strong revenue guidance looking ahead to FY25 and FY26.
And their valuation.
While it's higher than before they listed, it was noted as being lower than that of Titan or Kalyan at the time of the analysis.
Okay, so summing up PN Gadgil based on the sources. A regional powerhouse with a long history, showing strong recent performance and efficiency, actively adopting successful strategies, planning expansion, and with a potentially more attractive valuation.
Interesting. What about Senko Gold? What was highlighted about them beyond their strength in East India?
A key strategic focus for Senko Gold that was mentioned is their significant early move into lab-grown diamonds, or LGDs.
Ah, lab-grown diamonds. Yeah, they're highlighted as one of the early organized players really focusing on this area, apparently even rebranding to Senko Gold and Diamonds.
Lab-grown diamonds. That feels like a potentially massive disruption in the traditional diamond market, doesn't it?
It absolutely is. LGDs are becoming increasingly affordable as the technology improves and production scales up. This really has the potential to significantly change the diamond jewelry market, making diamond pieces much more accessible to a wider range of consumers.
So Senko's early strategic pivot towards LGDs is presented as a unique play, a way to capture this emerging segment.
That's how it comes across in the sources, yes. A unique strategic bet. It is worth noting, though, one source did mention a less positive observation from their investor call regarding management commentary around that Q3 hedging loss and their outlook. Just something to keep in the back of your mind.
Okay, so Senko is placing a big bet on LGDs. What about Tangamail down south?
Tangamail's strength really comes from its deep dominance in Tamil Nadu. which, as one source highlighted, is India's single largest gold-consuming state, accounting for a massive 40% of national consumption.
40%.
Yeah. And they focus heavily on the traditional gold jewelry designs that are extremely popular in South India. Their plans apparently include setting up large format stores and leveraging regional advertising to really solidify their hold on this key market.
Makes sense to capitalize on your strength in the biggest state market for gold. And finally, gold, the one you called the dark horse.
Yeah, Goldium. They have a really unique model among these listed players. They are backward integrated into manufacturing lab-grown diamonds themselves.
So they actually make the LGDs.
Correct. And their core business is primarily B2B, supplying these LGDs or jewelry incorporating them to large global chains, mainly in the USA market.
So they make them and export them mostly.
That's their primary operation, yes. However, they are also mentioned as testing a B2C retail strategy under their own brand, called Wejoieri, starting with stores in Mumbai.
A direct-to-consumer play.
Exactly. And they've reportedly given high growth guidance. Their potential is really tied to the success of this sort of nascent retail venture and, crucially, the continued strength of global demand for LGDs and jewelry, which, of course, introduces potential volatility because of that heavy export dependence.
Right. It sounds like a company with maybe a different kind of risk-reward profile, given that B2B global focus and the new retail experiment. Okay. We've covered the market, the tailwinds driving it, the key players, their performance numbers, their strategic approaches, all based on what we found in the sources. What about the inherent risks in this sector? What should someone looking at it be aware of?
Well, several risks were definitely pointed out. First, just the non-essential nature of jewelry itself. It's fundamentally a luxury item, right?
Mm-hmm.
So demand is highly sensitive to the overall economic cycle, consumer income levels, general wealth. If there's a significant economic downturn, demand could potentially soften quite a bit.
That's logical. It's not something you absolutely have to buy if your finances get tight.
Exactly. Second, gold price volatility. That's a constant risk. Significant fluctuations in gold prices can impact consumer demand. Demand might pick up if prices fall, but a sharp rise can definitely dampen enthusiasm.
Sure.
And maybe more importantly, as we saw with that import duty example, it directly impacts the value of the company's inventory. It can lead to significant losses if it's not managed effectively, ideally through good hedging practices.
So managing that price risk is just crucial for operational stability. What about the historical reputation of the sector? Was that mentioned?
Yes, corporate governance concerns were mentioned, primarily in a historical context. Traditionally, the sector involved a significant amount of cash transactions, maybe underreporting of sales. Now, while the listed companies are generally seen as having much improved governance standards, adhering to better compliance, and government regulations like GST, PAN requirements, hallmarking are definitely increasing transparency. It's still a historical factor worth considering. The sources mentioned, for instance, the challenges seen in some diamond companies back in the 80s or 90s as a kind of historical parallel regarding governance risks in this broader industry.
Okay, so while things are definitely professionalizing, especially with the listed organized players, that historical context is still part of the landscape.
Yeah.
And finally, I guess changes in government policy itself can be a risk.
Yes, absolutely. Unpredictable changes in import duties, taxation policies, or other regulations related to gold and jewelry. They can significantly impact the market dynamics and company operations, sometimes very quickly, as we saw with that recent duty cut.
Right. So while the tailwinds are powerful and seem pretty structural, these risks, economic sensitivity, price volatility, governance history, policy changes, they're just inherent to operating in this space. Okay, pulling it all together then, what's the overall outlook presented by the sources, and how might you summarize the key players based purely on this analysis we've done?
Well, the overall outlook for the organized part of the sector is seen as very positive. That almost unstoppable shift from unorganized to organized retail, that's huge. Combine that with the deep, enduring cultural significance of gold, the consistent wedding market demand, and that growing interest from younger buyers. It really suggests a path of steady growth for these organized players over the next, say, 5 to 15 years. The consumption theme in India, particularly targeting that affluent demographic, is seen as a really strong driver for the sector.
Okay, and based purely on this deep dive into our source material, how would you maybe characterize the companies we discussed? Just a quick summary based on this info.
Okay. Based only on this analysis from the sources, Titan clearly remains the sector king. Leader in scale, trust, has that significant operational edge in margins because of the leasing model. However, its valuation is noted as being quite high. So if someone were interested based purely on this data, the sources might suggest looking for entry points during market corrections, perhaps.
It makes sense. The leader, but pricey.
Then Kalyan Jewelers is presented as the sector prince, effectively scaling up, challenging Titan, using smart strategies like faux for expansion, focusing on higher margin studded jewelry. Shows good growth, though its valuation had also expanded considerably at the time of analysis.
Okay, the challenger.
Then you have the players, maybe, to keep on the watch list. These are primarily those regional players with significant potential if they execute their strategies well. That includes Senko Gold, especially interesting for its early strategic focus on lab-grown diamonds and its expansion plans.
Right, the LGD angle.
PN Gadgil, which showed those really strong TTM performance and efficiency numbers while actively implementing successful strategies and offering promising guidance. And Tangamail, with its strong base in that crucial Tamil Nadu market. The key for these, really, would be to watch their continued growth momentum relative to the leaders and see how successful their expansion and strategic initiatives actually are.
Got it. Regional players with potential. Watch execution.
And finally, Goldium is the dark horse. That unique model focused on LGD manufacturing, global B2B supply, with the potential upside from its new B2C retail venture. Its trajectory depends heavily on global demand and the success of that retail experiment, and it probably comes with the added volatility of that export exposure.
That's a really helpful way to frame them, based only on this specific information we've looked at. And it's so important to reiterate, as you said, that this entire discussion is an analysis derived solely from the provided source material. It's meant for educational purposes to help you understand the market dynamics and the players discussed. It is absolutely not in any way a recommendation to buy, sell, or hold any particular stock.
Absolutely. It's just about unpacking the insights from these specific sources and seeing what kind of picture they paint of this dynamic sector and the companies operating within it, so you can watch how the story unfolds from here.
Well, that was a truly valuable deep dive. A fascinating look into a sector that reveals so much about culture, economy, and evolving consumer behavior in India. We see the deep cultural roots, the powerful economic force of India One, that significant government-backed shift to organized retail, the varied strategies of the key players, the importance of operational details like inventory financing and hedging, and of course the inherent risks involved.
Hopefully you now have a much clearer understanding of this really vibrant market, the companies driving its growth, their comparative strengths and challenges as seen through the lens of these sources, and the major forces shaping its future.
And just to leave you with something to think about, here's a final thought to carry forward from this deep dive. Considering the undeniable momentum of the shift to organized retail and the potentially huge disruptive force of lab-grown diamonds making diamond jewelry much more accessible, which of these two massive trends do you think will ultimately have the biggest, most transformative impact on the Indian jewelry sector in the coming years?
That's a fascinating question to consider as you continue to observe this space.